Alrighty, we're going to get kicked off here in just a minute. So as people are coming in, find your seats, please. And we'll jump into a rolling start here as we're in the unenviable position of sitting between you and the Black Crows and cocktails. So we'll try to make this fairly interactive to keep folks awake at the end of the day. But thank you for joining us. I'm Byron Dieter. I'm a partner at Bessemer Venture Partners, and Philippe Baudry is joining me up here on stage, and we'll do a little ham and egg for you as we jump through the presentation. To set the stage a little bit, I want to give you a one-pager on Bessemer, so you know the context from which we speak. Everyone is biased in their own interesting and creative ways, so I'll admit up front that I'm biased in many ways. Part of that is from my Bessemer experience, and then I'll give you just a quick snapshot of my own background, and we'll jump into the meat of things here. But our topic today is going to be talking about cloud economics and the finance of a cloud business. And the reason why this is an area of particular interest to us is this is the area in which we work, and I've been on both sides of the table. Currently, as a partner at Bessemer, we have been fortunate to invest in and with a number of leading software and cloud businesses. But previously, I was also a CEO and an executive of a cloud business, and so I've been on both sides of the table. This is in terms of the Bessemer quick snapshot in our context. We're one of the largest and most successful venture firms on the planet, and quite proud of that. Literally created the venture capital industry almost 100 years ago now, 99 years and counting. And in terms of our role in the ecosystem, we tend to work with companies from the very early stages up through immediately pre-IPO. So think of it as hyper-growth technology from the guy and the dog and the business plan up to very late stage, high momentum, getting ready to conquer the world as a public company. We manage a couple of billion in assets, so even in these volatile times, we're not capital constrained, so we're able to support the companies all the way through from the $50,000 check up to the $50 million check in some cases. And in terms of the companies we've worked with, we probably have, we'll definitely have one of the largest software and software as a service and cloud portfolios in the industry. We've got just a subset of logos there. Many of these are historical companies that we are no longer shareholders in but still work with, ranging from Veritas, which we worked with early on, Skype, we led the Series A in, Parametric Technologies. We helped in the very early days. VeriSign was literally founded in our offices. You go down the list, as well as a number of, in the last decade, early SaaS and cloud companies. We've been privileged to work with a handful of the early nine-figure plus exits in the space, including companies like Postini, which was a very successful Google acquisition a couple of years ago, NetLease, Iota, Trigo, etc. And then on the middle and bottom of the chart is a handful of our current portfolio company names, many of whom are close Salesforce partners, are exhibiting downstairs, are mentioned in a number of the sessions that you'll be seeing, and are leading many of the presentations you're seeing themselves. And so what we've pulled together as we go into the content is really a thank you to this group, and reflects the feedback from this group. And our job as board members and investors is to try to spot trends and pattern recognition. So although we are summarizing it and presenting it back to you, really we have the executive teams of these companies and many, many years of history to thank for building up some of the early thinking in terms of what is important for you as executives of cloud companies to be thinking about, and how should you be building your business plan, your financial models, thinking about financing going forward, etc. As I mentioned before, I'll give you my quick background as well. I was first involved in this space as an entrepreneur, so I've worked with Bessemer for about 10 years, but the first half of that was as founding CEO of Trigo Technologies, which was an early software as a service business. We ended up violently violating one of our 10 laws of cloud computing, which was that we went to a hybrid model by virtue of being founded in '99 and building out our business in the early 2000s. We didn't have the luxury of selling against the buyer hesitancy of cloud computing and SaaS, and so we ended up doing some on-premise deployments. and it was our way of paying the bills and getting through the last nuclear winter. But with that said, we learned a lot from that, and that probably has made me more resolute in my belief that in this current day and age, you don't necessarily need to do that. And as we talk more about some of the principles of building the right SaaS business, a lot of what we're going to talk about today is based not only on our experiences collectively as a firm, as investors, but also broadly as operators. And so I've been in your shoes, as have many of my colleagues and partners. And I'll let Philippe introduce himself in a minute when he jumps in to walk through his material, but also a grizzled tech veteran and my partner in crime, as we've done a lot of the data gathering and thinking in this space around really what are the important elements that all of you should be thinking about as you build your business. To set the stage a little bit, we put out a couple of years ago a document called Bessemer's 10 Laws of Being Sassy, which was a fun white paper is probably the best way to describe it, which was a thought starter for a CEO conference that we do each year. We pull together our portfolio executives as well as a number of leading public company CEOs and leading private software as a service and cloud CEOs to really do that off-the-record interactive discussion that is hard to pull off in settings as great as this isn't a setting designed for that, and frankly there aren't many that are. And this was our attempt to pull together some of that thinking as thought starters for discussion, and also as a way to really try to bring together some of the best thoughts that group had contributed back and had come out of the discussion. And a few weeks ago we updated this specifically for cloud computing. In our view, we see cloud computing as being comprised of 3 layers. Software as a service is the top layer of this, certainly the most liquid, if you will, and largest today by virtue of being the most mature. But platform as a service and infrastructure as a service are emerging as critical components of that. And so we've expanded, revised, taken more and more feedback over the last couple of years, and have pulled together some additional thoughts that is now published in what we call the 10 Laws of Cloud Computing, and this is available online. We'll show the URL at the end, and we also, for those that are interested, do have some hard copies we can give to most of the group here at the end. But what we're going to do today is pull out specifically the finance-heavy elements of this, and we're going to do it in a way that hopefully won't scare you. This isn't a CFO deep dive, so to speak, but this is the most important finance-oriented metrics thinking, et cetera, that we've found is repeatable across businesses in the cloud space, and the basics, the metrics that matter, and the important thoughts that matter as you're building and driving your business that you should be thinking about as an executive team, that you should be compensating and tracking for performance metrics, bonus, et cetera, that you should be exposing up to your board of directors, and really judging as the business matures how you should judge your performance. And so what we're going to attempt to do today is frame that a little bit, and then we do have a lot of materials online. We've got white papers on many of these topics, et cetera, so that if you have questions on more of the details around this and you want to sit down with your CFOs, or you are a CFO and you want to figure out, hey, how do I actually implement this, then there's a lot more material, and we won't be able to go into that much detail here, but hopefully you'll be able to see the high level and get some of our thinking and certainly ask questions as we go through it, and then the depth is there certainly if you want to understand, hey, how can I actually implement this myself? And so what I'll do now is hand it over to Philippe, who can walk through the first element of this, which is the 6 C's of finance. And we use this, the metaphor, which is painfully obvious, I apologize, but if we're living in the clouds and cloud computing, et cetera, the instrument rating and the metrics that matter as you try to fly through this. And so I'll hand it over to Philippe, who can to walk us through this first section.
Well, thank you, Byron. So my name is Philippe Botteri. I've just a few words on my career. So I spent about a bit more than 10 years in the tech space. As you probably guessed from my accent, the beginning of my career was in Europe. So I spent more than 5 years there. I was with the technology practice of McKinsey and went through the early craziness of the dot-com boom, and then when that bubble burst, I moved to online services and the early days of SaaS and whatever acronyms it was at the time. After that, I moved to the States in 2003, still with McKinsey, continued my work around software and SaaS, and joined Bessemer in 2006, and I've been focusing on software investment for the past few years. So today I'm going to talk to you about what does it mean to fly a cloud plane from a financial standpoint. And so probably except for this room, but you probably have noticed that there are clouds everywhere. And it's kind of challenging to navigate in cloud because you don't know what's up, what's down, what's right, what's left. And so if you don't really pay attention to your instruments, you might have some problems. And you might say, well, that's true for every business, but it's actually not true because of the complexity of the recurring revenue model. So if you're selling a traditional software product, you have a CD, you give the CD, take the check. The maths are pretty simple. When you get into in a recurring revenue model, then things get a lot more complex because it depends when do I get the cash. I mean, first I need to kind of finance the implementation, and maybe I have a positive gross margin on my professional services. In that case, I get some money from that, but in some case it's free, or actually have a negative gross margin on my ProServe because that's a way to get the business started. And then how do I make all these numbers work? How do I know that actually I'm building a successful company and I'm not running down straight to the floor with my plane? So to answer this this question, we have put together a set of 6 metrics. And we do believe that if you follow these 6 metrics and you make sure that they are within a specific set of benchmark, and we'll go through this, what these benchmarks are today, you're going to build a profitable business. So even if some things go crazy, you think, well, I don't know what's happening. My cash burn is increasing as I'm growing. Am I doing the right thing here? My board is saying I need to cut the spend, reduce the cash burn. Is that the right thing for the business? And the answer is here. If your numbers, your key metrics are within this benchmark values, then you know that you're creating value, and you know that it's worth spending an incremental dollar for that. And that's, I think, critical. And I was yesterday with Josh James, the CEO of Omniture, on a panel, and one of the things he was discussing is when Omniture was growing like crazy, he's both like, well, should we really burn 20 million next year? And he had to fight and say, well, look at how the math is working here. Actually, we're creating value by doing this, and that's how he created one of the fastest, growing company in the industry. So the 6 metrics are, and we'll go in detail through each of them. So the first one is committed monthly recurring revenue. Number 2 is the churn. Number 3 is pretty obvious. You all know what it is. The cash. 4th is customer acquisition cost that we call CAC. The 5th one is a bit more, complex in terms of calculation, but the concept is fairly simple, which is a customer lifetime value. Is my customer over a long time period going to be profitable? And the last one, which is a new addition that we have put this year, is around the forward visibility on your sales pipeline, and we call that the CMR pipeline or C-pipe, just to make sure we have the 6 Cs.
And one voiceover to put here just to frame this is that we firmly believe that if you give us these 6 metrics, we can tell you if we want to invest in the business, how to value the business, and fundamentally if it's a strong business or not. We literally don't care about the vast majority of other metrics. And as we go through this, we fundamentally believe that these are the 6 elements that exec teams and investors will and should care about going forward above all else. And we'll tie these to more traditional metrics, and you'll see the linkages, but we firmly believe that increasingly these are the drivers of value.
Now we're going to get into the first one, and probably the most important, because it's really the primary driver of value creation for a SaaS company. It's called the committed monthly recurring revenue. What we mean by committed monthly recurring revenue is the revenue coming from a subscription. So that's the easy part, the recurring revenue side. so it excludes the professional services and all the non-recurring items. But the committed word is the most tricky one, because the question is, what should I put in? You know that from a GAAP standpoint, you can recognize revenue only if the service is running and implemented at the customer. However, it might take 3 months to do it, but you have signed a contract, and the beauty about SaaS is that when the contract is signed, there is a very high chance that the customer is going to get implemented and running. So you know that this revenue, even though you can't recognize it yet, is going to happen in a very near future. However, on the opposite side, you might have some customers who are saying, well, you know what, I've just been acquired by Oracle. They are not running your product. So when the integration is completed in 6 months from now, we're not going to use your product anymore and your subscription anymore. And so today that in 6 months from now, you're going to lose this revenue. And so the question is, well, is it still fair, even so you're still recognizing it and you're going to recognize it for 6 months? Well, is it really a value driver for the company? And the answer is no. And so by committed, we actually take into account these two parameters. One is the fact that when the customer is signed, then you can put the recurring revenue in the CMRR. And if you know that a customer is churning and there is a 100% chance that this customer is going to churn at a specific date, then you need to take it out. And obviously, there's always a question of, you think you're losing a customer, but there's still a chance you might still keep it. Well, in that case, that's a competitive process, so you still keep unless, until you know that it's really off. So that's why the acquisition case is a very good example, because, it's usually a certain case. So that's how we define the metric. And we think that this metric is the number one way to measure the growth of your business. And it's a very different way to measure things that you used to with enterprise software. In enterprise software, everything was measured in terms of bookings. And the bookings would be a 2-year deal, a 3-year deal, a 1-year deal, a 6-month deal. It would include some professional services. It might not include a lot of them, but everything was lumped up into a big sum, which was more or less equivalent to the cash you would get pretty soon. If you use this metric for SaaS, then you don't know where you're going, because you might think that a big booking is a good thing, but if it's actually a 10-year deal with a lot of professional services, the actual recurring revenue that you're building for the company is going to be very, very small, versus a very small bookings deal, which might be just a 6-month deal, because the customer just wanted a contract for 6 months, but with a very high chance of renewing. It might be a much smaller booking number, but much higher CMRR, and so much higher value for the company. So that's why we don't want, something we don't want to see in a business plan is, bookings, because we don't know what it means for a SaaS company. And the other thing is that bookings doesn't take into account the impact of churn. So we don't know, is it renewal? Is it not renewal? Is there going to be some churn in this number? So we don't know. So we recommend not using this term and this definition anymore. Versus with a CMRR, you have a full transparency on your business. You really know from a quarter to quarter what's happening. You look at the CMRR at the beginning of the quarter. You look at how many customers have churned, so how many dollars are you losing. You look at your upsells, so my current base, how much did they increase. Hopefully there is some good pricing leverage on the renewal, and some upsells you can do by adding different modules. And then there's the new customers. So you add all these, the 3 numbers to the CMR at the beginning of the quarter. You look at it at the end of the quarter, and you know how well your company has been doing. And that's, especially we'll get into some of, in the churn in particular in more detail, but this is one of the key numbers, because you can have a lot of new customers. If you have a lot of churn, then you're just trading water and not increasing any value. So the second C is cash. This is a fairly obvious metric. Everyone knows what it is. But we think it's important for a couple of reasons. One, because you're building a cloud computing company or a SaaS company requires a lot more cash because all the acquisition costs are upfront, and then you get the payment over time. So if you look at a company like NetSuite, they raised more than 120 million. Salesforce was 65 million. SuccessFactors 52. Overall, I would say the average for a public SaaS company is between 40 to 50. And you have some companies like LogMeIn, which managed to do it with only 30 million. But I would say they're more on the exception, and that's because they have a pretty neat way to leverage their technology and acquiring customer online with a freemium model. Because a lot of this, as we'll see, a lot of these dollars are raised for sales and marketing. So that's that's the first point, and Byron's going to come back to that at the end when you think about how should I plan the stage, the different stage of life of my company. When do I need to raise? How much? Obviously, at what's the valuation range? And we'll get into that in the second part of the discussion. The second element of cash is the beauty of SaaS is when you build your recurring revenues. Hopefully, if the churn is low, you keep them growing over time. And so as soon as your monthly recurring revenue hits the monthly recurring expense line, then your cash flow break even, you control your destiny, and everything is great. However, typically what happens is you make a plan for the line to cross at some point, and unfortunately, the monthly recurring expenses keep going up, and they never cross. So that's why it requires, especially in the current environment, very strong rigor about measuring your different metrics and controlling your expenses to make sure that the fact that these lines are going to cross is real, and they're not they don't continue to be pushed up. So what are the way to kind of control your cash? And there is one lever which is a pretty interesting lever, which is controlling your payment mix. So why is that so important? What is the impact for a company? If you look at a 5-year period, and what are the implications in terms of capital to raise, and of course dilution, which is not good for the founders. So the first company has a healthy annual mix of 50% annual upfront payment, get the contract, get 1 year upfront, you get the cash. 25%, you get 6 months of cash, 25% quarterly. That's a fairly healthy mix. And if we look at a company like NetSuite, for example, on average, I think they were at 9 months, went down to 6 months, in Q1, Q2 during the real downturn. And now I think they're back to more healthy mix at 8 or 9, so probably very close to this. The second company is half or semi-annual, half or quarterly. Last company is only quarterly payment. So what's the difference? Well, if your company is at roughly 10 million run rate, so 1 million CMRR, growing with 60% per annum CAGR over 5 years, the difference is pretty high. I mean, 38 million between the first and the second company, 52 million between the first and the third company. So when you look at these numbers, you say, well, maybe I need to revisit my sales incentive plan and make sure that I give the right incentive to my sales force so that I make sure they get a better upside for selling the annual payment. And of course, in this environment, it's a lot more difficult. Customers are pushing back, but having just these numbers in mind kind of help you make the right trade-off.
One way to think through that is that's around a financing. So the ability to swing payment terms alone at scale and volume can take out an entire dilutive event, which, call it 20% ownership right there, is the power of contract structure.
So the next metric is a churn, and actually, the left side of the chart is, the template is directly from a board meeting, and we said that to, put that together, and that's what our companies are reporting. And there are two ways to look at the churn. The first one is to look at the gross churn. So looking, if I take my CMR at the beginning of the year, at the end of the year on the same customer base, how much do I get if I exclude upsells? And typically, we want this to be in a 12% per year, 1% per month type of thing. And obviously, this is an average if you're selling into mid-market. If you're selling into lower customers, so more the very small businesses, 1 to 10, 1 to 15 employees, and this number is probably going to more in the 15 to 20% range. And then if you're selling into enterprise, we have companies in the portfolio where this numbers is 5% per year or less. But on average, if you're at 12%, you're doing good. The other way to look at it is to say, well, if I take my customer base at the beginning of the year and look at their CMRR, and now I take into account all the upsells, so potential increase in pricing, potential addition of new modules, then are things offsetting each other, and are the upsells compensating for the churn? And if you look at this chart, it's fairly interesting. You see, where do I want to be? And I would say the average, you want to be at 0 so that the churn is compensating for the upsell. So if you don't invest in acquiring new clients, you have a business that can go along for quite a long time without lowering its value. And so that's a very interesting one to measure. And so you need, when you start the year, as you start about your 2010 planning, you should think, well, my business has a 15% share. How can I try to extract 15% more, 20% more from all my customer base so that this would offset it? What's my pricing lever? What are the new modules I'm going to push? What's the best way to structure my offering so I can upgrade some customers? I think that's a very powerful lever. And obviously, churn, the number one thing about churn is making sure that you monitor it accurately, you understand the root causes, and you have an account management team that is looking at it very carefully and making sure that all these causes are eliminated. And another here example of the benchmark for the same company, 12% churn versus the 20% churn, is equivalent to $12 million. So still a significant impact, but if you compare that to the payment term, obviously you see the trade-off here. So we've talked about the revenue, talked about the cash, talked about the churn. Now the next one is around, how do I grow the business? Well, to grow the business, you need to invest in sales and marketing dollars, and you want to understand when I put one sales and marketing dollar on the table, how much do I get back? And there are two ways to see to look at how much do I get back. You can look at the revenue, which is the more common metric. But the problem with SaaS companies is some businesses have a 90% gross margin. If you look at LogMeIn, very high gross margin. So revenue is actually a good proxy for gross margin. If you look at companies like NetSuite, well, when they started, they had a 50% gross margin. So then, the dollar of sales and marketing doesn't get the same return. So to offset that, we actually prefer to look at it from a gross margin perspective. The other thing we prefer to do is instead of looking at the aggregated GAAP revenues, which is a blend of subscription and professional services, and unfortunately the only metric you have for a public company, when you're looking at your own private company, then you have access at all the metrics we talked before. And the number one metric for the value is the CMRR. And that's what we use for the customer acquisition cost ratio. So what we do is we look at the incremental CMRR in a given quarter. So how much CMRR did my sales and marketing team generated? Multiply this by 12 to annualize it, and times gross margin. So that's the net recurring gross margin created during the quarter. And you divide that by the sales and marketing cost. And I think you need to make sure that the sales and marketing cost excludes the account management side. Because you're talking about acquiring new customers here. You're not talking about upsells. You're not talking about churn management. You just want to know that if you add another salesperson, hunter on your team, then how much is that going to generate in revenue? So that's how we define the ratio. And then the rule of thumb here is pretty simple. If your ratio is 1 or above, meaning that for each dollar of sales and marketing you get $1 gross margin or more, then it's a fairly good return on investment. Just step on the gas, send us an email at cloudvc@bvp.com, and we'll give you the money, no problem. Now, if the CAC ratio is less than 1/3, meaning that it takes 3 years to get back your sales and marketing investment, well, then in that case, you're in a bad spot. And you don't want to raise money. You just want to step back, reduce your sales force, and try to find a way to make it more productive. And then when you found it, that's time to raise more capital and scale the business. And if you look at the public benchmark right now, which is a bit biased because it's just based on GAAP, so it's less accurate, but it's around, it's between 0 and 0.7 with a median on 0.4. So that tells you the level of productivity of this company at this point. We'll see later today that actually it went down and now it's trending up again. So economy has been a bit better in the past quarters.
Just to add a thought, companies all the time ask us, hey, I'm thinking about raising money, should I do it? Or, how much money should I raise or what should I do? This is the answer. We just ask them, what's your CAC ratio? Do you have a money machine? If we put in $1, how much comes back out the other end? And venture capital is expensive. It is not right for all companies. But if you have a positive payback loop, we would argue it's more expensive not to do it because you're giving up market share and you're essentially destroying value by not investing in growth when you've got a favorable payback. And so this is an example of one of those metrics that you're not tracking daily because it takes trends, but you're certainly tracking monthly or quarterly. And when you see this moving to the positive territory and when you see a payback, one of the unintuitive dynamics of this model is that it actually costs you more to grow faster. But if the payback loops are short and your retention is high, then a little bit of venture capital, little on a relative basis, tens of millions in some cases or millions in others, can produce huge multiple effects on the back end in terms of the wonderful nature of the subscription revenue stream. And that's a fabulous way to accelerate growth and build extremely high long-term value in a business.
So now, what is the impact of, and that ties to what Byron was just saying, which is, what's my cost of capital here? How much am I going to burn to grow the company? And so here is the example of a SaaS company which is starting in year one with 1.6 million of revenue, so fairly early stage company. And we compared, and this company is the green one with a CAC ratio of 1. So fairly good productivity on the sales and marketing side. And we assume that the company managed to get this productivity constant for the next 5 years. And then on the other end, you have another company which is getting a productivity ratio of half of it, meaning I put $1 sales and marketing, I get only 0.5 of recurring gross margin. And we look at the difference over 5 years, and this difference is 66 million. I mean, that's huge. That's at least 2 venture rounds, late stage venture round to grow the company. And you might say, well, the model is crazy. No company's burning 35 million a year. I mean, look at NetSuite and SuccessFactors pre-IPO. I mean, they were even more than that. So these numbers are actually real. I mean, they actually map to what these public companies were showing. And if you look at LogMeIn, for example, and look back, then the numbers are much closer to the 7 and 8 at the beginning, and then very quickly trending to 0. So you can see the impact on this CAC ratio. In one case, you keep going down before it actually goes up for a much longer time. And as it's proportional to revenue, the more revenue you have, the more burn you have. And when you kind of go across this threshold of the 1-to-1, then you see that you don't dip too low, and then you quickly ramp up back, and then on the 6th year, you're actually starting to be break-even and generating a bit of cash. So a very key metric. So the last, not the last, but the next metric is the customer lifetime value. So I mean, before getting all the numbers on this chart here, I think the concept is fairly simple, which is you're building a recurring revenue model. Your customers are going to be recurring customers, and they're going to generate a revenue stream beyond the first year. So hopefully you'll keep them 4, 5, or 6 years, based on depending on your churn rate. And so the question is, overall, when I acquire a customer, what is the net value I'm getting out of it? If I take on one hand, first I need to invest sales and marketing dollar up front to get it. Then over time, I need to have my account management costs, and I need to have also, some R&D and G&A costs that I need to run the business. So if you look at, and so you just need to do the analysis and say, well, for my business, am I getting to an equation where I'm creating value, or am I actually destroying value? And so if you take here the example of, take $1 of, annual recurring revenue. Let's say you have a 70% gross margin, so this customer is going to generate, 70 cents of gross margin for 5 years. You have a CAC ratio of 1, so the acquisition cost is, minus 0.7 the first year. So the first year, you're going to pay some R&D and G&A costs. So you have a negative cost at the beginning. And then you see that on year 2, then you don't have the customer acquisition cost anymore, but you have your account management costs and still your R&D and G&A. And hopefully, starting year 2, you generate a profit. And that's why, when you look back at your CAC ratio, this is critical, because if you had a CAC ratio of 0.5, then you know that the second year you're still not generating any profit, you're still losing money. So each customer you acquire generate negative cash flow year 1, but negative cash flow year 2. And then you start only creating money after that. So you need to make sure, if you're at this 0.5, that you can keep your customers a lot more than 2 years. Otherwise, you're obviously destroying value. And then so you look at this projection of profit streams for your customers, and you might apply a discount rate if you want to be more precise. But basically, you add just these numbers and say, am I getting to something positive or not? And just by looking at this very simple equation, you can say, well, when do I start to see some cash back from my customer acquisition, and is that the way I want to build my business? And at the end of the day, when you add them up, you're negative. You say, well, let's put all the brakes on and think a bit of how to redesign the model so that this is generating profits going forward. And you see here that you have different levers. You have the gross margin levers. What can I do to increase my gross margin? You have your account management costs. You have your R&D, your G&A. So there are a lot of different levers beyond the sales and marketing acquisition costs that you can play with to make sure that this equation is working. The thing we tend to see too much in business plan is say, well, gross margin is really bad today. We're running at 35% gross margin, but we know with scale it's going to be much better. And so you start drafting it going to 90% gross margin. Usually doesn't work out that way. I mean, you look at a company like NetSuite, how much time they took to go from this 50% or 45% gross margin to today, I think they're around 70, 75. It took them 10 years to get there. So don't assume that suddenly your gross margin is going to be at a software level, enterprise software level of 80, 85%. And just to make sure that this is not just theory but works in practice, I just run the number for Salesforce, just based on their public number, and you can see that over time they've consistently got to a positive customer lifetime value, and that's why you have 19,000 people today at this conference, and that's why they're still generating cash and continue to invest in doing great things. So the last one is the CMR pipeline. So as you're looking at your revenue from a CMR standpoint, it's also very important to run your sales force on a CMR basis, and that means incentivizing your sales force on a CMR basis. That also means that you need to monitor your sales force on a CMR basis. And a lot of our portfolio companies today have set up Salesforce so that for each deal they can see the CMR of the deal, along with obviously you need to have the total deal value and so on and the terms, but they want to see the CMR for each deal, and they know how valuable this deal is, and that helps the top management team prioritize its efforts on which deal they should get involved with and when. And then at a macro level, when you aggregate all these CMR numbers, that actually gives you a very clear perspective, going into the quarter or the next couple of quarters, what the real level of your pipeline, and how much of this you're going to convert, and how will this translate into increasing your CMR and so growing the value of the business. So as you think about building your own CMR pipeline, there are typically three things you need to think about. The first one is the time frame. What's the right time frame for my business? Should I look at it on a monthly basis? Maybe if constant contact selling to small businesses and have all your sales force running on a monthly basis, that might be the right number. Maybe it's a quarterly basis. Maybe it's 2 quarters. Maybe it's more than that, depending on the type of business that you're running. But that's the number one question you need to solve. The second question is about the stage. I mean, as you all know, when you look at Salesforce, you look at the different salesperson, and you try to weight. This salesperson is always over-optimistic. This one is under-optimistic, and so you run the numbers of which one, which percentage you allocate to this one. So, basically, what it means is you need to get to a level where you feel pretty consistent in terms of what you're putting in your CMR pipeline. Because the most important thing is consistency over time, because that's how you measure the improvement of the business. So you might say, well, for me, any deals more than 30% is good to put in the pipeline because that's the culture of my sales force. I know that this 30% is a real 30%, and that's a good constant indicator over time. For other companies, it might be, well, I just put the 80% deal because all the rest is crap. I don't know what the rest is going to generate. So you need to think about that and adapt it for your own business. So that's I think everything on the CMR pipeline. So just think about this different stage and probability at the end. Just summarizing what we just said. I mean, as Byron mentioned, to look at a company, we need to look at 6 numbers and how these numbers are trending. And the 6 numbers are the CMR, the cash, the churn, CAC, CLTV, and CPIPE. And I let you read the different benchmark levels for each of them. And the good thing is, if you're within these benchmark levels, at some point when you're at scale, when the growth starts to slow down, and you've built a business that is going to generate 20% free cash flow margin. So you're really building value, and it's going to pay out over time.
Yeah. And we'll take this back up in a minute to talk about how this rolls in your plan. But the thing I would say, obviously, is these metrics are at different levels and time frames. And so as an example, when I was sitting in your shoes running a SaaS business, CMR and cash I knew pretty much daily, certainly weekly. This was something that when we did our e-staff meetings, we reported on, we talked about in those terms, full visibility, full awareness, the heartbeat of the business. With churn, customer acquisition cost, and customer lifetime value, there's a longer lead time to these things. A few deals, particularly when you're still early stage companies, can swing the numbers a lot. And so those are more quarterly trends, even semi-annual trends. You've got to be aware of them. You've got to be aware of the issues, the levers, what you're doing to improve them. But don't be intimidated by either the complexity of the calculations or this notion of I've got to pull a lot of data together. They're critical. They're important. Those aren't things that are daily rhythm of the business type metrics. And then I'd say the pipeline is somewhere in between, in that is your leading indicator to future CMRR. And so it's important that you have some consistent definitions so you can track that trend and how it's moving. But similarly, we all know that you run a big marketing event, the pipeline gets full of a bunch of stuff, and it takes a while to work through, or you go through, the sort of the rhythm of the quarter, and so people are qualifying up front and cultivating, and then they're closing at the end. But collectively, these metrics over a medium-term time period, as that executive dashboard, really do give you that, the readout of the health of the business and answer the next order question of, should I be raising capital? What types of capital? How should I be thinking about this business? And really, what's the potential of the underlying business here? Anything to close out before I jump into just this last section?
I think that's pretty much it. So now we can move to the how do you think about 2010 and overall lifetime of building your SaaS company.
Okay, so I'll just spend about 5 minutes so that we can leave hopefully 10 minutes here for questions. But to bring this back to now that we've set the stage for the metrics that matter and how can each of you look into your business to understand that overall business health, the next questions are, hey, how do we think about our individual business plan or business plans, and what does this mean? So the two questions are, how should I think about valuation, and what are the capital needs of the business? The valuation question is it's part art, part science. When we were here last year, I'll tell you that it was a pretty ugly situation, and so we were in the painful position of being the bearers of market data at that point, which was we were in a world of hurt. We had taken our licks in a pretty big way, and the average SaaS company was trading at 2.3x revenue. And these, by the way, were based on the top 13 public SaaS pure plays on the planet. So the absolute best SaaS companies, arguably, in the world, including Salesforce.com, were trading just over 2 times revenue. The good news is that things have bounced back pretty considerably. I was surprised when we pulled the data that we're only down 13% net off of the year-ago point. 2 years ago now, but think of it as the SaaS high before we went into this nuclear winter. And we're back to a 3 to 4x revenue multiple, which isn't the peak. We've seen 5 to 6x over time, depending if you're thinking of trailing or forward, but fairly healthy valuations. At least something that we can all look around, and from our side as hyper-growth investors, at least we can look at it and say, okay, there's some common definition of what is fair value. So valuation isn't as much the issue now. The issue is much more, what are the capital needs of the business? How should I think through fundraising? How should I be building out the business? And so as you think through it, 2 more pieces of good news, and then I'll give you a sample plan. The reality is, as the metrics have come down a little bit, the competitive dynamics are still reeling in what is a tough economy. And so whereas your businesses may be growing at 50% now and you're kicking yourself because you're not growing at 100%, the reality is the big guys have really come down dramatically. You're looking at teens growth rates for, again, the top SaaS companies in the world. And you're looking at CAC ratios, as Philippe just said, really for a private company, 1 is a realistic target. The public guys were able to do that at massive scale, hundreds of millions of dollars of revenue. They were still able to have customer acquisition cost payback periods in a year on a gross margin basis. They've fallen dramatically off of that in this period. They basically kept their sales and marketing teams reasonably fixed as sales productivity took a huge hit. They responded by making some cuts, which, just as we've seen in terms of the jobless recovery, and we see the stats of, productivity comes back before employment comes back, same type of thing. The sales productivity came back on a company-by-company basis, but we've now seen that, as the numbers are trending back, and we're seeing it a couple of quarters, and as companies are starting to hire back, our hope, and probably your hope as well, is that this is the beginning of a bit of market recovery, and you can look at it and say, we're going to see sales performance that approximates pre-crash levels, and for small companies that are, not having to grow off bases that are, 100 million or hundreds of millions of revenue, that it is absolutely still possible to grow at, 50%, 100%, 200% levels, even in a volatile market environment. We see that in our portfolio, and I'm sure that's the case for many of the folks here in the room. So how you should think through next year. We don't attempt to have a crystal ball. We're not going to make any predictions of the market. There are people much smarter and much better positioned to do that than we are. What we will say, though, is that the 6 C's of cloud finance should give you a sense of, if I invest, what does that produce for me? What is the payback? You then need to figure out what your cost of capital is and make the decision of, how aggressively do I want to invest? What I would say, though, is the second bullet here is it might be time to step on the gas, which is this thread we had before of when you see the numbers are positive, it can actually hurt you more by not investing in terms of long-term value destruction or opportunity cost, however you want to think of it. And then with the volatile market, customer retention, particularly when you step back on the gas for growth, can often be the thing that's lost in the shuffle and the craziness. And we would just say that can be kind of the back door or the hole in the bottom of the funnel that ends up costing you a lot if you're not attuned to scaling that organization with customers so that your customer lifetime value remains in check and you're able to really build this sustainable brand, sustainable business that will create that lifetime value that you need to really create the market cap that you all aspire towards. with the, the second major bullet reiterates sort of this point of don't underinvest. And then the third is cheap MRR. A lot of times people say, hey, should I be acquiring competitors? We've got situations where, they're really wounded and we can pull them in. In general, we're not big fans of private-to-private deals. It's complex. It slows you down. There's 50 reasons why these things generally fail. But with that said, we've seen a number of unique opportunities over the last year in particular where our companies have chosen to be selectively aggressive, and it's paid off already. They've been able to buy customers, buy revenue, et cetera, roll it in, and find some pretty interesting value, get to some larger scale at historically cheaper prices than if they were to continue to acquire those customers directly and build it out directly. If you think about then what does that mean for my business plan as an executive, this is a rough example of the average hyper-growth, successful SaaS business. If you were able to be a public company in 7 years based on those that have done it, this is roughly what it would look like. The vast majority of you are probably sitting here saying, I don't want to raise $40 million, or I don't need to be a billion-dollar public company. I'm quite happy if I'm a $100 million business, or in some cases a $10 million business. So, take off a zero or take off two zeros to all these numbers. But you get the idea. And we've often found that if you shoot big, it allows you to fall a bit short of the mark and still do very well. So, but this is that sense where these businesses do consume cash early. We all know it. You could argue it's a lousy model where all your costs are front-loaded and all your revenues back-loaded. But as we know with the cable companies and telecom companies, et cetera, is once you're hooked, it is a long-term money machine, and these businesses can benefit massively from it. And so this is a rough sense of what a three-step fundraising process would look like, some rough sense of what you'd raise, valuations, et cetera. But there's a long list of outliers, and I can give you plenty of examples of companies that have blown through this and raised a lot more money at a lot higher prices, or businesses that have bootstrapped all the way through and just raised a final round for expansion or not needed to raise. But I think this is as good approximation as any in terms of how to think through that go big strategy if that is right for you. And then to leave some time for questions, I won't go into detail on this, but we do have it on our website, and we talk about revenue recognition. Once you build the plan and you're managing the business by the metrics, hopefully you will get to a point where accounting does matter, because Wall Street is still very fixated on product-based financials and things like inventory and GAAP revenue and the like. And so there are some peculiarities that those of you that have gone through an IPO process with a public subscription business or SaaS company have already dealt with these. Those of you that are going through audits as a private company and switching auditors or dealing with the changing opinions will deal with these. It's a mess. In general, though, think of it as you need to map most sources of revenue to the expected contract duration, and there's, it's pushed out and recognized ratably over the extended period of time, with several exceptions that we talk about much more online if you want to read the full white paper and the details. And then here's the snapshot, and with that, I'll turn it over for questions. I'll say that we hope you're all facing the dilemma of the fifth bullet here, which is hey, put in a lot of blood, sweat, and tears. We're in a crappy market, but things are starting to work, and we want to know how to thoughtfully step on the gas. And we hope we're attending your conference in a few years, where 20,000 people are lined up to be your partners as well. So with that, any questions, please? And hop up to a microphone if you wouldn't mind. They requested that we capture this on recording. Yes, please. Absolutely. So the question was the customer acquisition cost calculation.
Well, exactly. So it's you take the annual gross margin value and divide it by your sales and marketing cost for the quarter, which is what you invested to get to this annual value. And I think that just a nuance that we want to mention on the sales and marketing cost is you need to separate the account management cost. which needs to be matched against the renewal of your recurring revenues and not the acquisition of new recurring revenues. Sorry? Actually not. That's a good point. So it should be sales and marketing.
Oh, that's funny. Good catch. That's a typo, yes.
That's weird. Yeah, it should be sales, yeah.
Oh, that's funny. Yes, we've got it correct. We do have a copy of the white paper with the actual corrected equation if you guys want to grab it afterwards or online. Sorry for that. Any other questions? Yes. Oh, sorry.
So the question is, how do we calculate the R&D cost in the customer lifetime value? So it's not an easy question, and I think here it's more art than science. I think the way I typically look at it, and that's the way I did it for Salesforce when I looked at their numbers, is say, well, if I look at my P&L today, how much am I spending in terms of percent of my revenues, how much am I spending in R&D? And if that's 10%, and that's the 0.1 number here is corresponding to 10% of the revenues. That's how you do it. And so, of course, if you are in a high growth mode, and you know that today your sales and marketing costs are 20%, but you know that 3 years from now they're supposed to be down at 10, then you need to bake that into your your calculation. I think the idea here is to make sure that you get the value of your customer when the model is at scale. But the trick is don't be too optimistic about where you will be at scale. That's, I think, the key part of it.
It's sort of the sustaining engineering team notion from enterprise software, that you're trying to think of. What is the technical cost to maintain? Yes, thank you.
Yes, no problem. Can you elaborate on that? I think it was the last metric there. You had in one of the slides, CMRR, CPI. Okay, target is 3 to 5 times the CMRR for the quarter or something like that?
Sure, the coverage ratios?
Yeah.
Yeah. So every business will have a slightly different definition of the pipeline metric that matters to them and different coverage ratios that are necessary based on sales cycle and conversion rates to hit the number. Anecdotally, for a business that's on roughly a quarterly sales cycle, so think of it as an SMB SaaS business, then the forward quarter pipeline metric can be sufficient, and a 3 to 5x coverage ratio traditionally seems to work as long as your pipeline is defined as qualified and above. You can't have this, hey, I just loaded a massive list of opportunities into my Salesforce system, and boy, I just doubled my pipeline. We all know that multiplying a massive number times a small percentage doesn't really help you. However, if you have thoughtful qualification, and we're big believers in marketing automation and lead scoring, and this notion of marketing qualified lead, handed it over to be accepted as a sales qualified lead, and rigid steps in the sales process, so you have scoring methodologies that are consistent and measurable over time, then you get a pretty thoughtful pipeline metric that is indicative of, hey, what is this forward end of our funnel? And I can start to see a quarter or even 2 quarters out of my business and then drive the ship ahead. Whereas if you flip it, and if you're take the extreme gap revenue in a SaaS business, you're actually trying to drive, by the rear view mirror, a couple quarters behind. And so in aggregate, that's a year swing in your business. And the good news for you is Wall Street investors are often looking still at gap revenue. So a year before they do what they're going to see, and you can ramp up, you can do all sorts of things to really control your business in ways that you couldn't before. Alrighty, we've got time for, it looks like, one more question. Yes? Yes. So the question is, how do you value a company that has no revenue? Facebook was the example. I would put Facebook in a different camp, obviously, because they do have several $100 million in revenue, and it's a very high multiple of revenue, but at least there is ad-based revenue to value there. But all day long we talk to companies that have 2 founders, and a woman walks in with a business plan and says, I'm going to conquer the world, and it's a year before even a product exists. What do you do? That's the art of the business. And at the end of the day, there's rough examples, and you sit down, and if you're doing an incubation, oftentimes you won't even value the company. You'll do a convertible note, or you'll do something to just get started. But it becomes a market dynamic, and as entrepreneurs, the best thing you can do, and it kills me to say this, but is go out and get multiple offers, get multiple people interested, and make sure that there's an efficient market so that you're going to have clear visibility into what pricing should take place. And as a company goes from 0 revenue to IPO, you're going to go from hopes and dreams metrics and multiples to financial multiples. So by definition, your multiples are going to decline and start to converge to the public market multiples. But the more you can talk about the big potential, the more you can show the vision and capital efficiency and those things, the more people are going to be willing to take the bet and be aggressive with dollars raised and valuation. Alrighty, well, we're available afterwards if you want to chat. Otherwise, thank you for your time. We do have booklets if you want to walk out with some of the materials, and enjoy the rest of the show and the party tonight.